it's not just since yesterday that we call China world's factory. Right now, however, we have a real problem. Millions of lower wage workers whose work is bolstering the economy right now is on the brink of having been done out of their jobs. That comes out to one thing. If China won't have enough processing capacity of the economy, we would have an excessive reliance on surging debt that in recent years has made the countries of China growth model highly unsustainable. That may have global reverberations here and there. So what does it mean for us investors? Today we're gonna answer this question and many others. That's why I'm glad that you have appointed right here. Thank you very much for tuning in, and without any further ado, let's get into next episode of Blockrevision. And we are jumping to economy view. Let's get to the first subject of today, that is the most debated recently among economy around the world. So we have right now problem with China COVID lockdown protests. So we have noticed that some of the resurgence of cases that literally has spooked local authorities into reintroducing measures that may expand testing, shuttering offices and schools in big cities. And even though we had new directives over a week ago that marked an easing, right now we can find that they are following this COVID-0 playbook once again. So we cannot find whether that may ever end. And that's why huge crowds gathering and protesters at many locations were calling for President Xi Jinping to step down. We had also heavy police presence in some areas of Shanghai. It's very difficult for Xi Jinping to backtrack from hardly established, already proved wrong policy. China wants to live normally. Chinese people wanna work. Bear in mind, China is not one of these Western manufacturers comply with various health, safety, employment, and environmental regulations. Chinese manufacturers generally operate under a much more permissive regulatory environment. So why cannot they withstand barely few cases of somewhat genetically modified flu around their area of work, and why don't they just let it go as easy as it came in? That's the questions without the answer, but the one thing is obvious. Whether it's Russia or Ukraine, authoritarian regimes never puts out truth on the table. China will hold on their misleading guidance about condition of the country till collapse. Right now, emergent to get triggered are subsequent supply chain disruptions and diminishing consumption demand, at least in the short term. Main victims of the turmoil already been prices of oil and copper today on the markets. Let's have a look at the chart that recently been getting better, but right after those COVID measurements been reintroduced, we may once again get back to this dire situation. So customers around the globe should expect further bouts of volatility, as that what is happening is hurting supply chains once again. Container shipping costs from China has been lowering by now, and the fourth quarter might be the one where it may rebound. Maybe not for good, maybe for the new highs eventually and hopefully, but that's the one thing that may bother customers and producers around the globe. So that's how it looks. Container shipping costs from China. And let's get to another hotly debated topic today in many media. So the question is why liabilities and capital has dropped to that level. Earnings remittances due to the U.S. Treasury recently has slided. So we can find this drop. What implications may it bring if it remains in negative for a long time? So the factor that will drive the deferred asset higher is the fact that the Fed hasn't officially stopped raising rates yet. Right here on the chart you have a function, as you can find at the bullet points, of the Fed now having to pay a higher interest rate to banks to park their cash at the Fed. So right now it means that we will face even higher interest rates costs over time. The Fed has penciled in more rate increases while it seeks to lower inflation, which by central banks' preferred times is a preferred measure, is running at more than 2.5 times its 2% target, and is eyeing a funds rate of around 4.6% next year. So should we bother about this chart then? We literally are in a longest period of lowest interest rate level ever. Easy access to markets in the wake of pandemic enabled many companies to refinance their debt immediately, but nothing lasts forever. We have already noticed reduced government spending and economic slowdown following this. That is a hard situation we found ourselves at. So it seems to be result. This chart seems to be result of hiking rate period, and that's it. Unless, in order to cover the losses, government will seek out potential increased taxes, as it almost every time boils down to such move. And that's the thing that always reverberates badly on stock market results. So we will track that chart very carefully, and we'll let you know about the new revelations. So if you haven't subscribed to the channel yet, consider this, and you won't regret. Okay, there will be much more useful content. All right, so we are right now jumping into a market outlook. Let me, at first glance, let's have a look at the chart window. As a reminder, if you haven't noticed, right here you have below my window a chart that I will relate to as quick as possible. So if you have any questions just that are bothering you, just don't hesitate, pause it and I will get back to them during or after transmission in the comment section below the video. So market outlook, what we have out there, the question is what's next with US dollar. So recently we've had this moment where US dollar was losing its purchasing power very rapidly. So right here we had this situation where hedge funds were selling the greenback for fifth straight week and held a net short position. Asset managers boosted short exposure by most since July 2021. So we have very similar situation where we had back in February, where price action at the moment actually resembles that move, that kind of strength of a move. So we are closer to the rebound of DXY than anywhere we've been throughout recent year, and that's something that we need to consider when taking investment decisions. So dollar trades with a positive tone lately, and the latest positioning has gone the other way. It could be that options traders will keep buying topside structures as to reflect the chances of another rally in the spot market. And if you just consider not option market buy, but also commitment of traders prepared by CBOE, we right now finding out that commercials are steadily increasing their engagement into the market of dollar. And that's why there are more signs that we are on the brink of a return of dollar to the levels, higher levels around few to 10% or even more in relation to the other currencies. So I mean the DXY, there is closer to a rebound of DXY than it was previously during that 8 or 10 months of rally. So in the bear markets right now, as we are on the stock market bear markets, we can find that every single spike in price in those major indexes might be treated as the possibility of getting out of the trade. That's why I do find that DXY may have its return in the days to come. So I will just extend the view. So on your right you have the positioning of traders, and on red you have commercials positioning. If it rising, it means they are decreasing a short positioning that they were holding back then since July of 21, and right now we can find that this tendency is reverting itself. So that's the one we need to take care of. Crypto outlook, what we have out there: Bitcoin in central bank reserves. Is that right? Is that possible? So we had this publication being introduced by Matthew Ferranti, pointed out that Bitcoin is an optimal alternative hedging asset for central banks. So Ferranti argued that there is a merit for central banks to hold a small amount of Bitcoin even in normal circumstances. Apart from this, the researcher believes that the risk of sanctions may eventually spur diversification in central bank reserves, strengthening the value of crypto and gold. We all know that central banks are on the partings of the ways when it comes to introducing Bitcoin to the structures. On the one hand, it has all necessary features that gold has, but they seem to find it still suspicious as it hasn't been created on Wall Street. The question is, however, whether Wall Street has a monopoly of making up scarce assets. Far from it. We are living in a world of decentralization of an idea, and by centralizing everything, we will make our system radically ineffective. In terms of central banks, however, we know by now that they have mastered offering assets that have very often diluted mechanisms underneath, not mention about US dollar. What is worth noting also, we've seen a rise in the correlation between BTC and gold recently as an indicator of investors' confidence in Bitcoin during the current economic downturn. May that spark, the question of mine is, may that spark another bull run of Bitcoin when it turns out to that the banks eventually tilt to Bitcoin? Let me know in the comments section below, or right now during the chat. I would like to know your point of view. So that's the point about the Bitcoin. Right now, let's have a look at the whole sector. Right now, we can find that after the effect of FTX that has led to a lengthening of what would be considered a crypto winter, a period of people's lack of focus on the space or lack of trust in the space, we can find that during that period, usually we have seen a slowdown in usage of ATMs and ETFs. Right now, on your left, you have the outlaws just been noticed by, or rather the backtrack when it comes to the installation the installation of ATMs, crypto ATMs, and on your right you have the flows of cryptos ETFs, and that's the solely one ETF that literally gained on the recent time. We had the purpose that was the one that was gaining, but many of them were losing. Besides this, that 1 year earlier, mainly all of them were registering inflows. So right now we can find that something that has happened is not unprecedented. Mt. Gox filed for bankruptcy in 2014. Quadriga CX and Cryptopia, Canadian and New Zealand countries' largest crypto exchanges back then, collapsed in 2018-19 and was later ruled to be a fraud and a Ponzi scheme perpetrated by the founders. Right now we have FTX. So 4-year crypto cycles are supposedly experiencing right now a turning point, when we had the fallout of many very prominent crypto entities back then. Right after clearing out this environment, we had a much more interest of insiders of smart money than previously been ever noted. That's why I do expect that if you have just started accumulating Bitcoin, you won't regret in 2 years. But that's what history speaks, and you have to be cautious anyway, as those 4-year cycles may to some turn of events someday fade. That's why you always need to be very, very reasonable in terms of taking investment approach. Okay, so what we get right there, market mover section. In terms of market movers, we are always jumping to economic calendar, and let's find out what's up on the markets this week. We had speeches in the US that are worth listening, as they might be a tip for what to expect from Fed in the beginning of December, when taking another approach to interest rate hike. Will they slow down, or rather there is another data that may bring over that possibility to hike by 0.75. Right now, I don't find that will be possible of hiking. Sorry, I need to get some water. So I do expect that probability is in favor of those bears rather than the hawks. In terms of those two hawks, as I wouldn't expect of Fed to hike by that amount, but every options is on the table. You need to take notice on that. On Tuesday, however, we have inflation rate out of the Germany, and it's expected to lower down a bit, so we'll find out. Recently, DAX German index was the one that was gaining the most among many indexes, to our surprise, as the basis the base on what it rose wasn't that solid as a rock. There are many underneath problems that are flocking the German economy. However, it looks like those downside moves were too extended. That's why we need to rebound more fiercely. We have Canadian data, GDP growth rate. That's also worth watching. Inflation rate out of the Euro area. Some countries, among them there's France, and that's the whole for Euro area territory. We have ADPs, GDPs out of the US, and job openings, and Fed Chair Powell speech on Wednesday that will tell us the most about the current condition in their viewpoint. And we are ending up the week somewhat boring, as we just have only ISM manufacturing PMIs, and we also have non-farm payrolls that, however, might be more interesting than the first day's data. So that's it out of the economic calendar. Let's find out what we have out there in terms of market opportunities, as we always end up with that section that is a trade idea. And in terms of trade idea, let's right now find out what it's on my radar today. On my radar is HG1 copper futures. Right now we are in a great spot for the another slide downwards. Now we can find it. Let me find out. So copper futures has been in this downtrend since April of this year. Right after Russia invaded Ukraine, copper started to sell off within 1.5 months and is right now rebounding out of this triangle pennant structure and continuing a sell-off downward further. So copper futures right now has formed the pattern that right now confirming that and validating previous previous supports, and right now we have tested this support out of the March of 2021. After validating this support and testing out that price, we can find that the answer of the market was the one that we don't really need to comment. There were an abrupt sell-off, and this sell-off means literally that the market don't want that high prices for the copper. So copper futures has sold off, and that slide has lasted throughout about 1 week, right after we have formed a right ascending wedge arm that literally in 65% breaks down to the downside, and with this mark information, with this clear out of so this faking out of structure, we very often tend to reverse in a rapid pace. Now, that's why we do have kind of a very strong reaction to this breakdown, but we need to take a notice that we are prone to filling the gaps right after it occurs. So right now we are filling the gaps and continuing with a high possibility march downward. So the first one objection for the type of pattern is the extension of 3.16. That's around 13 or around 12.4% of slide. So if you ask me, I would also check commitment of traders at first, and in terms of commitment of traders, let's have a look at this one. We right now have commercials that are right now panically running out of their positions right on that spike, and that's why I do expect that also will relate to what the price behavior may throw up within days to come. So copper futures right now are on my radar, or I would just literally possibly take that position against copper within minutes after a transmission. So if we just want to be ahead before me, you may take it right now, but you need to always be very cautious in terms of taking a risk. So always set your alarms, and I will tell you where to set it to not get bust. So as I said, my first stop is at those levels of 3.31, where the bigger, that's the one of 3.37. That's the one I would expect to sell the first part of my position. So in terms of trading board, that's risk reward ratio at 7.5. It's very, very decent. That's why I do find this proposition as very lucrative, and I do expect for those that are latecomers for today transmission, I do find the one who won't watch it live or just couldn't make the transaction right away, I do expect that this price should oscillate within this area if making this bet valid. So always after taking a trade, adjust your trade position and stop losses or alerts at least. So I do expect when the price of copper will get out of any of those boundaries of this blue box, I wouldn't find my proposition of a trade as valid. That's why you should better take some rush if you are interested in this. Always take your own point of view, do your own research, and don't blame anyone for your mistakes, as you need to know what you're doing in terms of trading. That's always a risky game. That's the game of probabilities. I will try to show you where the odds are, but you need to be very cautious in a way, as I always may make some mistakes. In today's episode, that's looks like that's everything. Thank you very much for tuning in, and hopefully you will join Blockrevision and hit that subscribe button. And if you enjoyed, click the thumbs up button. I'll be very, very happy about it. Thank you, and see you tomorrow, 8:45 East time, every single working day. Bye bye.